But now to shift gears and get some insights on the news that are shaping the overall markets, I am joined by Ted Thatcher, president of Bright Lake Wealth Management. Ted, always enjoy our conversation. So appreciate you being here to kick off our show this week. Now, on the Iran and ceasefire talks, we know that there's a lot of concern, but what do you see as right now the single biggest maybe market signal that is showing that risk is truly coming out of this market and not perhaps just in a pause or being ignored?
Yeah, Jenny, I think I was looking on Facebook over the weekend and Iran updated its relationship status with the U.S. too. It's complicated. I feel like we're playing the most high stakes game of she loves me not with the Strait of Hormuz. And I think the only reason we can have some levity and joke about this topic is because for the last 50 days, the market has gotten headline after headline after headline about the Strait and what's happening and not happening with the prices of oil. And at this point, I think the market's tired. It's got this headline fatigue. And of course, we see that in the equity markets. 3 days last week consecutively, the S&P closed above 7,000. This morning, obviously, a little bit of pullback, but really not too bad, especially considering, some of the headlines that we did see over the weekend.
Okay, and I loved what you mentioned about it being like a complicated relationship status. It did take me back, and I could not agree more. And so with some of these markets and the headline fatigue that you just laid out after weeks of nonstop breaking news, what would you see as having to happen for headlines to matter again and reprice this risk rather quickly?
Yeah, obviously we have our eyes on the price of oil. In order for this to take a real negative turn, we're going to have to see some really negative sentiment. That's would have to come in the form of, I would say, the ceasefire just completely breaking, some real activity on the military side for investors to start saying, okay, we really need to reprice this risk. Even still, though, the way I look at this, I mean, maybe we do see some chop this week. Maybe we see a little bit of pullback, but I do not believe that we're headed back to those March 30th lows when it comes to the conflict on Iran.
Okay, so with the VIX still sitting right now just below 20, actually, we're nearing at least the 20 handle, though. Does that mean that investors are underestimating some of the overall risk here, or does it simply reflect that most of the shock is already priced in?
I do believe that it is already priced in. I mean, last week we saw the VIX, hit a lower in that 15 range. Obviously, with the headlines over the weekend, bumps up a little bit. Not too surprising. Again, I just don't see that this is the way that this conflict is going. I think the market is so efficiently priced around this. It's saying, hey, this is, more or less behind us. It's kind of a little bit, I think, making light of it to completely sweep it under the rug. But I do think in a lot of ways, that's the way the market's behaving right now. And it's focusing instead on what has led the market for so much, time behind the war in Iran. And that, of course, is AI. We've seen so much momentum back in that topic. And really, that is what the market seems to be focused on.
Okay, and I do agree that it does seem like more and more this tech trade is starting to reboost this overall sentiment and everything around like the software pullback. But if you do see some more chop continue to trickle into the markets this week, where do you think is the most important area of focus as far as growth, inflation, geopolitics, and of course, earnings?
Yeah, earnings are really interesting this week. Obviously, I want to see what happens with Tesla. There's so much sizzling under the seams here of just what direction they're going, what progress they're making. So much of the push up in Tesla's valuation has come because of technology. Pushing the limits of their technology capabilities. And so that's really what I have my eye on with Tesla. Obviously, I want to see what happens with some of their car sales. ServiceNow is another name I'm really interested in. Obviously, you mentioned software. I think in general, software, obviously, we've talked about it a lot, the software apocalypse. It's gotten hammered really hard in throughout the war in Iran. Valuations have come down so substantially. Oracle's a name that has stood out to me. We saw it hit its highs last fall, come down since then 48%. It's almost like the market has forgotten that Oracle is one of the fourth of four of the big infrastructure hyperscalers in this AI boom. And so I think that just purely even from a pricing standpoint, that name sticks out as a potential opportunity for investors.
Okay, really interesting because you mentioned, the enthusiasm tied to Tesla, Oracle, ServiceNow. all names I know that there's been whisperings of like the overvaluation. Like these names are now, I mean, previously at least were at really high valuations. Oracle, I will say, doesn't typically trade with, as lofty of a valuation as some of its like high growth peers. But when you balance some of these valuations, would you say, looking at the fact that we're still well off of highs, like you said, almost 50%, that you're getting things at a relatively good deal and you're trying to find some of these names that could be seen as like earnings winners this quarter?
Yeah, absolutely. And obviously, these names have come down because there's been some concern about, the future and earnings and all those things. And so whether or not they're perfect beats or not isn't so much, my concern. And specifically with Oracle. ServiceNow, I think, is a different story. I do want to see, strong earnings there. Tesla has just been a mixed bag when it comes to earnings. Sometimes they'll beat. Obviously, the market always loves an earnings beat. But again, I think with Tesla, the valuation, really has had so much to do with the cutting edge technology that they've been pushing. And so I'm looking really in that lens, much more on the robotics side. Again, just to come back to Oracle really briefly, I do think that they have a story that's been a little bit, in my opinion, more beaten down than they've earned at this point. And so again, just from a previous valuation standpoint, I think there's some opportunity there.
Yeah, I think for a lot of these names that we're looking at and like substantial repricings, there's going to be very interesting earnings moves, I can imagine, this quarter. But on more of the consumer front, consumers, I've heard many different arguments. Many say that the consumer has remained fairly pressured. We know that 54% do say they are in a worse position than they were, say, a year ago. But in your view, is this more of a demand slowdown story, a margin pressure story, or perhaps both?
We could talk about the consumer in a lot of different ways. And yes, they do say, more than half now, that they're in a worse position than they were a year ago. And why do we think that that is? Well, obviously, we could talk about the inflationary consequences of this war. The way that the Iran war is going to affect Americans at the end of the day, Jenny, is in their pocketbook. We saw, CPI come in 3.3% year over year. Now, because of some of the consequences when it comes to, energy prices, we saw PPI actually come in with a 4 handle. PPI is always one of those that I have my eye on because, of course, it's the prices that businesses are getting. And that, of course, is a leading indicator. Think about it as a bubble that moves through the economy and then, of course, ends up affecting the consumer. Also, I've noted that the core numbers, the core CPI, the core PCE, they remained lower. Of course, why? Because they're filtering out energy prices. And so when we see this inflation potential mounting, affecting consumers as that bubble moves through the economy, I have some concerns. And naturally, it is hitting them on the other side too, which is the labor market. If you look at January of 2024, since then, if you strip out healthcare, the labor market has been shrinking. 1.7 million jobs have been created in healthcare since January of 2024. All other sectors combined have lost 56,000 jobs. And when you put this all together, you start to see why, the Michigan's consumer sentiment report came in as low as it did at 47 at its last print.
Yeah, and I do think that it's a great explanation of some of the recent turbulence we've seen from economic data. I still think amazing to see, frankly, the resiliency of the consumer, but really great points there and a lot to keep on our radar as we, of course, set up the trading week. But so appreciate it. Ted Thatcher, president of Bright Lake Wealth Management. Thanks so much for joining us to help us kick off the show today.